Good day, learners. Welcome to your first lesson for EMS Term 2. In this lesson, we will be looking at the different steps in the accounting cycle. Let me first explain what is an accounting cycle. The accounting cycle is a sequence of procedures used to keep track of what has happened in the business and to report on the financial effects of these procedures on the business. So it is a process of recording the financial transactions and also their effects in the business. Okay. So the accounting cycle includes the following 6 steps, which is transactions, source documents, journals, general ledger, trial balance, and financial statements. Let us have a look at our first step, transaction. A transaction is a financial action or event that takes place in a business between a buyer and a seller, expressed in monetary terms. In grade 7, we learned that a transaction is a business deal where money is involved. There are many different transactions that happen in a business daily. For example, a business receives money, a business pays out money, and a business deposits money. So all these transactions have to be recorded in the books of the business. This takes us to our step 2 of the accounting cycle. Complete a source document. A source document is used by the business to record transactions and it's normally completed in duplicate. It is the source of information for accounting record. It serves as a proof of transaction. So when a source document is completed, it is completed in duplicate. A copy will be given to the customer and a copy will be kept in the business for accounting records. This copy that is kept in the business is evidence that a transaction has occurred. Examples of source documents are receipts, cash register slip, cash register tape, bank deposit slip, invoices from sales and purchases. After completing a source document, we move to step 3, recording of transactions in the journals. Transactions are recorded on a daily basis in the books of entry, which are CRJ, CPJ, DJ, DAJ, CJ, and CAJ. In grade 8, we focus more on the CRJ, which is cash receipt journal, and the CPJ, which is cash payment journal. All these journals are referred as subsidiary journal. Journals need to be casted and cross-casted at the end of each month. This means journals must be added or totaled at the end of each month. After the journals are added and totaled, they have to be posted to the general ledger, which is step 4 of our accounting cycle. Posting is the act of transferring information from journals to appropriate accounts in the general ledger. The general ledger has 2 main sections, which is the balance sheet account section and the nominal accounts section. The balance sheet accounts are balanced and the nominal accounts are totaled at the end of each month. So the general ledger is basically a summary of all the journals. At the end of each month, The journals are totaled, and then information is transferred to the general ledger. We move to step 5, which is to draw up a trial balance. A trial balance is a list of all accounts and their balances all total. It is used to check the accuracy of a double entry system in the general ledger. It is prepared at the end of each month. So a trial balance is used to check the accuracy of a double entry system in the general ledger. So it actually lists all the accounts that appear in the general ledger. And also it verifies or checks, ensures that the general ledger has been prepared correctly. In our previous lesson, we learned about a double entry, which basically means that for every financial transaction, there is at least 2 accounts that are affected. Therefore, for every debit, there'll be credit, or for every credit, there'll be a debit. After drawing up a trial balance, we prepare financial statements, which is step 6 of our accounting cycle. Financial statements are used to report the financial position and results from operating a business. The main financial statements are income statements and balance sheets. Let's look at the income statement. An income statement determines the profit or loss made by the business during the financial year. It shows all the income and expenses for the financial year, and their difference results in either a profit or a loss. An income statement actually shows the income that we received as a business for a 12-month period, and also the expenses that we paid for the 12-month period. Then it will show us whether we made a profit or a loss for this particular period. Let us look at a balance sheet. A balance sheet is a statement that is prepared to determine the financial position of the business at the end of a financial year. It shows assets, owner's equity, and liabilities of the business. A financial period is a period of 12 months, and it is very important that the financial statements are prepared at the end of the accounting period, because it helps the owner to see how the business has done for the financial year. For this 12 months period, the owner can judge from the financial statement and make informed decisions judging from the financial position of the business. So it's very important to prepare the financial statements and ensure that decisions are based on the position of the business. We come to the end of our lesson. Please do complete activity 1 below on your notebook. I hope this lesson have assisted you somehow, and we will meet on our next lesson.